Welcome back to Brashonomics. Lucky enough here to be with Dennis Gibb, President of Sweetwater Investment, a company he's successfully grown over 20 years from zero to $1.4 billion in assets under management. And, well, first of all, welcome back, Dennis. How are you?
I'm fine, Ben, but I'm really shocked, I have to tell you, that you actually think that politicians wouldn't give us the full truth about anything. I mean, I'm just shocked.
I don't even think they give us half-truths.
Well, I don't think they know what truth is.
No, it's just sound bites, and it's obnoxious. I'm glad it's almost over. And
no, because we'll just start the next cycle.
Yeah, that's true, right? 4 years out or 2 years out. So, Dennis, a lot of there has been talk about the economy, and what does seem to ring true to me is that people don't necessarily, the politicians, don't necessarily take history lessons and, in order to create economic policy. It's a lot of sound bites and whatnot without concrete plans of maybe looking backwards and what happened in the past and figuring out, well, how did it work? How did things get better back then that maybe we could use now? Talk a little bit about, what you've seen over the years and maybe some of the market crashes of the past and the ways they could protect themselves.
Well, one of the advantages of being old is that you've seen a lot. George Santayana once said that those who forget the mistakes of the past are doomed to repeat them. And that happens again. And so this is appropriate because Friday was the 25th anniversary of the largest single percentage and point decline in the history of the stock exchange, worse than 1929. It was a crash of 87. You were, what, 8?
I was 8.
Yeah, Heather was 2. So it's a long time ago.
If it was October of 87, I was 8.5.
Yeah, okay, sorry. I was 41. So anyway, it was a big crash, and it really affected a lot of people. And to this day, there's an argument about why it happened and what happened. And, I was there. I was working at Bear Stearns in San Francisco, and there were a lot of very funny things that happened. We came in the Friday before had been very bad. And Monday we came in, and it was obvious the market was going to be down in a big way. Within about an hour, the tape of executions was running about an hour late. And then by noon, it was running 3 hours late. So if prices you were looking at on the exchange were, you were seeing Caterpillar at 47. That was what it was 3 hours ago. It was probably 26 at that point. So you couldn't really do anything. And that probably saved a lot of clients because they just, they weren't going to buy something 3 hours ago. The ones who were smart went in and put just crazy low bids in, and some of them got them. But it was really bad, and the news got out around it. And I remember at noon, San Francisco time, there were 4 sales assistants that sat outside my office. And in unison, they all yelled out, "Dennis, your mommy's on the phone." And my mother had called to make sure I was okay, and I wasn't dangling out of a 17-store window or something. But anyway, so why did this thing happen? All right, the first thing was that there was an untried investment technique, 2 untried investment techniques called program trading and portfolio insurance. Program trading is still with us, and basically what that is there's a computer program written which executes stocks based upon the relationship of stocks and indices and bond markets and this sort of thing. Today we call them algos, and that's still around. The other one was a thing called portfolio insurance, and this has to be one of the stupidest things that's ever been created in life. What this said was that the way you protect yourself in a down market is that as the market goes down, you sell more. So this is what you got. You wanted a boat all your life, a particular boat, and you finally find the boat, and it's $100,000, and you decide to buy the boat, and you're just happier than a clam because this is a dream you've had.
It's a nice boat.
Nice boat, yeah. Six weeks later, you're at the slip at some marina, and in comes the next slip, exactly the same boat, and you go over to talk to the guy, and he says, "Yeah, how much you paying?" He says, "I paid $75,000." So, according to portfolio insurance, you'd sell your boat. And then if you found another one for $50,000, you'd sell more boats. And you'd keep doing that until the market stopped. Now, that makes no sense, does it?
Well, you only have one boat, Dennis.
Yeah, I know, but you can short boats. See, in the market, you can short goats. You can have 4 cows and create 500 cows. So people would just keep shorting, and so it kept putting pressure on the market. Well, in those days, the markets were controlled by what we called specialists, and it was an open outcry system, and people would get around these pits, and they'd yell at each other, and they'd trade. These were private companies who had their own capital at risk. And they had to buy when everybody else was selling, and they had to sell when everybody else was buying. So if there was a lot of selling without any buying, they would get in trouble because they're buying the stock and they would use all their capital. Well, about 3 o'clock, 2:30, 3 o'clock New York time, one of the big specialists reached its capital limit and was going to go out of business, and eventually had to be bought by Merrill Lynch. But when that happened, the banks all pulled their credit lines from all these specialists on the floor, and the market almost froze at that point. The exchange got on with Alan Greenspan. Greenspan put pressure on the banks opened up the spigots again, and the market fell another 300 points. But there was still a market going on, but it almost froze that quickly, and it was all because of this stupid portfolio insurance. Also, the Fed had been pulling liquidity out of the system because of the currency valuations and things like that. So the question is this: can it happen again? Yes, because portfolio insurance now is called high-frequency trading. And there's more of them now than there ever were portfolio insurance, and they are 65% of the volume on the New York Stock Exchange on a daily basis. And all these are some computer out there, being run by some geek who could never get a date in high school or college, and so he became a computer guy. And he's sitting out there running these math things, and he has no idea. He don't know a stock from a duck. And he's just out there. He's written his computer program. It's going to sell or buy or whatever it is. And we've seen this happen before. The other day, a company called Night Trading was trying a new technique. They got it running, and there was something wrong with it. It cost them $167,000 a minute while the thing was running. It eventually ended up eating $400 million of their $800 million capital in less than 12 minutes. Okay.
You think at that point in time you would unplug it?
Well, you would think so, but I think these things are like Hal in whatever that movie was, where everybody smoked dope at one point. Anyway, all I remember is Strauss music in there. So this can happen again, and the question is, will it happen again? And the answer is yes, it will happen again, and it's going to be worse than '87 when it happens. So be prepared. So there's some lessons to be learned here. Okay. First of all, always stay objective in your investments. Don't let other people tell you what you're supposed to be doing. You make your decisions. You decide what you're going to do, and stay objective about it. When people are crazy, as Kipling said, when everyone's losing their head and blaming it on you, you should be doing the opposite. In other words, if you're scared, you should be buying. If you're feeling good, you should be selling. Second, always buy on fear. When there's blood in the street is when the greatest bargains are out there. Always have a crash scenario list of stocks that you want to buy or something you want to buy, that if it got to here, I would buy it regardless, and be able to execute that. Remember that what goes up fast will come down faster, and probably before you think it's going to come down. There is no such thing in the stock markets that it can't happen. Everybody has said, well, this can't happen, that can't happen, and guess what? It happens. So always be prepared for what's going to happen. Tune out all the daily noise, and that includes CNBC and Jim Cramer and all those other idiots out there that are telling you to do stuff. Learn to listen to yourself. Do your own research. Find trusted people. I will tell you, I've been doing this for 40 years, and in those 40 years, there are exactly 8 people that I've ever known on Wall Street that if they called me up and said, buy this, I would buy it without doing my own research. I mean, you talk about politicians lying. I mean, Wall Street, everybody lies to everybody else. The fool is the guy who believes the lies. So you don't listen to these people. The calendar is not an effective way to run a portfolio. So don't sell in May and go away necessarily. That sometimes worked, but sometimes it didn't. This year, if you sold in May and went away, you lost 10% return on your investments. Bet with your head, but not over it. And investors now are facing greater risks than they ever have before because of high-frequency trading and because of the interconnection of this around the world. If this thing gets going like '87 again, it's going to be far worse because you're going to have markets all over the world caving in.
Well, Dennis, you talked about tuning out the daily noise, the Mad Money and the stock pickers, which literally now there's like 4 or 5 channels that'll tell you how to be rich within like 15 minutes. It's amazing. But then you also talked about having a crash scenario, shopping list of companies and prices. If you're not really in tune with the markets and you're not supposed to listen to the TV, and you say there's 8 people in the whole world you would trust, how does somebody else go about finding somebody who they can trust to maybe help them create that crash scenario plan or that isn't on TV?
Well, the way you do it is you call area code 425-861-0112 and ask for me. No, that's a shameless plug.
Yeah, I love it. I love it.
Yeah, I'm not even paying for this either. So anyway, the way you do it is you find somebody over time that you can trust. Find a person that you agree with. They have the same principles as you. They have the same outlook on life. You know, I'm not saying that young people can't do this, but oftentimes young people don't have the experience that an older person has. They don't know how to take a longer view. Find somebody that agrees with you. Somebody not agrees, but has. But the best test of an advisor is, can they disagree with you and you still respect each other? That's the best thing. If they're always yes manning you, guess what? They're going to yes man you right into the poorhouse.
And that goes right back to what we had talked about at the beginning of the show, was the politicians who are lying, or going back to the investment advisors. Oh yeah, no problem, we can get you those returns, or the real estate agent who says we can sell your house for more, or whatever it is. It's more than just trust. It's finding somebody who, like you said, can disagree with you and will, because there's a good chance if you're not in the investment world every day, you're probably wrong at a lot of stuff.
Well, even if you are in the investment world, you're still going to be wrong. I tell people, I get some of my best investment ideas from my clients who are looking outside and looking at different things than I'm looking at. You can't know everything. There's just too much information out there. So you know what you know, and the true mark of genius is that you know what you don't know, and you're willing to get help. Most investment advisors will never admit they don't know anything because, we're perpetual 17-year-olds. We think we know everything.
Dennis, sometimes I think you do know everything. Thanks again for joining us again, Dennis Gibb, President of Sweetwater Investments.
Thanks, Ben.
Ooh, you're welcome. When we come back, when you know that house that maybe looks like the dream isn't, Jim Estrada does. He goes into those houses and he'll let you know what's going wrong with them so that maybe that big lie doesn't end up becoming your big mortgage. We'll be back after this break.